In October 1929, the world changed in a matter of days. Fortunes disappeared, banks collapsed, factories shut down, and millions of people who believed they were secure suddenly had nothing. This was not just a market crash, it was the beginning of the worst economic disaster in modern history. This is the story of the Great Depression. The 1920s in America were electric. They called it the Roaring Twenties. New technologies were transforming daily life. Radios filled living rooms. Automobiles crowded the streets. Skyscrapers pierced the skyline of New York. The stock market seemed unstoppable. Optimism was everywhere. And that optimism turned into speculation. Ordinary people weren't just saving money, they were investing. Teachers, factory workers, shop owners, everyone wanted a piece of the stock market. And they didn't just buy stocks with cash, they bought them on margin. That meant borrowing money to invest. You could put down just 10% of the stock price and borrow the rest. If prices kept rising, profits multiplied. But if prices fell, losses multiplied just as fast. Few people considered that possibility. Because prices had been rising for years, it felt permanent. By 1929, the stock market was dangerously inflated. Stock prices were far higher than the actual value of the companies behind them. But as long as everyone kept buying, the illusion continued, until it didn't. On October 24, 1929, later called Black Thursday, panic began. Investors rushed to sell. Millions of shares flooded the market. Prices dropped sharply. Bankers attempted to calm the situation by buying large blocks of stock. For a moment, it worked, but the fear had started, and fear spreads quickly in financial markets. Then came October 29, 1929, Black Tuesday. Over 16 million shares were traded in a single day. Stock prices collapsed. Billions of dollars in wealth vanished. Not gradually, instantly. The stock market had crashed. But the crash itself was only the beginning. Banks had invested heavily in stocks. Many had also lent money to customers who were now bankrupt. When stock prices collapsed, loans could not be repaid. Banks began failing. People rushed to withdraw their savings. Lines formed outside banks across the country. But banks don't keep all deposits in cash. When too many people withdraw at once, the system breaks. Thousands of banks failed. Millions of Americans lost their life savings. Businesses began collapsing next. Without bank loans, companies could not operate. Factories shut down. Workers were laid off. Unemployment soared. By 1933, nearly 25% of the American workforce was unemployed. 1 in 4 people had no job. Families lost homes. Bread lines stretched for blocks. Shantytowns, often called Hoovervilles, appeared on the edges of cities. The crisis became global. The United States had been a major lender to Europe after World War I. When American banks failed, those loans stopped. European economies suffered. International trade collapsed. Countries raised tariffs to protect domestic industries, but protectionism only made things worse. Global trade fell by more than 60%. The world economy was shrinking, and no one knew how to stop it. At the time, President Herbert Hoover believed the economy would correct itself. He avoided large government intervention, but as conditions worsened, pressure mounted. In 1932, Franklin Roosevelt was elected president. He promised a New Deal for the American people. When Roosevelt took office in 1933, the banking system was near total collapse. He declared a nationwide bank holiday. Banks temporarily closed. The government inspected them before allowing them to reopen. It was a bold move, and it restored some confidence. Roosevelt launched massive public works programs. Bridges were built, roads were constructed, dams rose across the country. Programs were created to employ millions. The government intervened in ways it never had before. Social Security was introduced. Banking regulations were strengthened. The role of government in the economy permanently expanded. But even these measures did not immediately end the Depression. The economy remained fragile throughout the 1930s. recovery was slow and uneven. It wasn't until World War II began that full economic mobilization finally ended the crisis. Factories restarted, unemployment vanished, production surged. War spending stimulated massive industrial output. By the early 1940s, the Depression had finally lifted, but the scars remained. The Great Depression teaches powerful lessons. First, speculation fueled by easy credit is dangerous. Buying assets with borrowed money amplifies both gains and losses. Second, trust is fragile. When trust disappears from the financial system, panic spreads faster than logic. Third, banking systems must be stable. When banks fail, the entire economy suffers. And fourth, global economies are interconnected. When one collapses, others follow. The 1929 crash was not caused by a single event. It was built over years. Overconfidence, excessive leverage, weak regulation, and the belief that prices would rise forever. History shows something consistent. Booms feel permanent, crashes feel sudden, but neither is accidental. Financial systems move in cycles. Optimism grows, debt expands, risk becomes invisible. Then reality returns, often violently. The Great Depression reshaped the world. It transformed governments. It changed economic theory. It altered how central banks operate, and it left a permanent warning etched into financial history. Markets can rise for years, but they can fall in days. And when they fall far enough, the consequences are felt for generations. That is the story of the 1929 Great Depression. Not just a market crash, but a global turning point. A reminder that prosperity built on fragile foundations can collapse faster than anyone expects.